post-election rally. We'll speak to Tobin Marcus of Wolf Research as Trump unveils another batch of cabinet appointments, and Earl Davis of BMO doubling down on the United States. We begin this hour with stocks lower as the Trump-fueled rally hits a bond-shaped wall. Attention turning to CPI data at 8:30 Eastern as investors price in fewer rate cuts. Seema Shah of Principal Asset Management saying the rising likelihood is that come early 2025, the Fed is likely to slow its cutting pace to every other meeting, with some risk that rates don't fall as far as either the Fed or the market had originally envisioned. Seema joins us now for more. Seema, welcome to the program. Let's pick up on that last line, that rates might not fall as far as the market envisioned. We've had a big repricing over the last few weeks. I think we're pricing in basically 3 cuts over the next 12, 13, 14 months. Do you think we can reprice that even more?
So thanks for having me on, John. Well, I don't think, typically what we've seen actually over the last 18 months or so is that the market really overreacts. That's why you see these wild swings in interest rate expectations. I don't think you're going to see a further repricing, but I think it's a case where, there's going to be a long debate, of course, as you've been talking about on the program, what are the actual policies going to be? How much are tariffs going to increase? What's going to happen to the deficit? What happens to immigration? These are all inflationary policies. But also, there's also going to be that debate through all of 2025 about what is a neutral rate. So there's so many forces at the moment which are making a little bit more uncertain of how far the Fed really needs to cut rates, how much it can cut rates. So I think that for anything, as we look to 2025, whereas there was some certainty about where the Fed was going to go, I think there's a huge cloud above that now.
Seema, we've priced out a lot of those rate cuts, and yet this equity market is still close to all-time highs. And credit spreads have been incredible. Let's just sit on credit. Investment-grade credit spreads, the tightest so far this century, trading at 74, sub-100 basis points. High-yield credit spreads, 253. Levels that we really haven't seen, both in high-yield or investment-grade, going back to pre-GFC. Now, Seema, when you look at those levels and how tight they are, can you get a bigger sign of confidence from investors than that one right there?
So, and I think this is key, is that, we talk about, people talk about all the risks out there. What is Trump going to do to the economy? What is it going to do to inflation? But the credit market is telling you that investors really are not worried. They're actually very, very positive about the outlook. And to me, it makes sense. Yes, there are risks on the horizon that we need to keep a watch out for. But if you're looking at broad risk assets, unless you're going to see a significant increase in inflation, which really upends almost the way that the narrative is moving, it's quite difficult to be positive about the market. The one caveat to this, so is again, back to what you're saying about credit spreads, is that at these tights, how much tighter are they realistically going to go? And is the story going to be anything more than just carry?
Well, this is the thing. All the past year, Seema, you've had a bond market that's been swinging from narrative to narrative, from recession to inflation concerns, all the time while equity markets have been remarkably strong. And let's be honest, at least to this point, have been right on the strength of this economy. So are risk assets still right at this point? Is that the signal you want to be following?
I think it is. I think that is the pathway that we were looking at. There's all this uncertainty, but I think the one thing that we can say is that the election result and what's coming out from there is just simply reinforcing a narrative that was already in play before the election, which is that of a soft landing. So if we look at earnings, that still looks pretty solid. We talk about deregulation. That's another positive to throw out there. If you have got worries about inflation, which I think it is something that investors really do need to be aware of, alert to, cautious of, I think it's already out there, then again, that plays out to cyclical equities. So I think the risk asset story is still pretty solid. Valuations are probably going to put a bit of a speed limit, but at least the story is still for positive returns through 2025.
Even so, it's almost as if stocks are trading in that kind of disinflationary regime where bond yields can go higher. And the assumption is because it's of growth, so they can continue to rally too. Seema, at what point does that end? What do we need to see in the economy, in bond yields, that equities can't rally at the same time as yields push higher?
So I think it needs to be, what is driving those yields higher? Is it really about growth, or does it start to pivot and become something more concerning around inflation? The idea that you almost have I wouldn't say quite stagflation, but at least that stagflation narrative starts to build up, as well as concerns around the deficit. So what is the rationale? What is the reason why yields are rising? And I think today, certainly there are some concerns playing out there, but by and large, a lot of this move is actually about the strength of the US economy.
Seema, when it comes to the 10-year yield, there's been a lot of analysts talking about the fact that maybe we will hit 5%. Do you think we could see that in the next 6-12 months?
Well, I think, look, the negotiations around what happens to the tax cuts is going to be prolonged through next year, which means it's going to be top of mind, which means that there's going to be elevated bond volatility. And the vigilantes, you know, as many as there are, they're probably starting to gather. So I think there is a risk. I think some of the numbers that maybe have been thrown out that I've seen in recent weeks of 7% on the 10-year is, I think, highly unlikely. I think the bond market will almost, I guess we are hoping that the bond market almost acts as a regulating force for the government. So any push towards 5%, I think the economy is strong enough to handle, but I think it's enough to maybe push the government back and start to really reconsider how much fiscal stimulus they really need without the risk of crowding out investment and really starting to upset the fundamentals of the U.S. economy.
Larry Summers basically said this. The bond market is going to have to educate some lawmakers in Washington, D.C., but that's one side of Pennsylvania Avenue. What do you think President-elect Donald Trump is regulated by?
I mean, this is a question I think everyone is asking themselves, is that, you know, there is elevated uncertainty. We don't really know what's likely to happen. There's a lot, you know, policy proposal doesn't necessarily mean policy action. And we are trying to figure out what is that regulating force. Is it going to be bond deals? Or, on the other hand, is it going to be actual inflation? You know, we think Trump was voted in because of discontent around price levels, about the cost of living. A lot of his policies are actually inflationary. So I think a lot needs to be said, or needs to be still seen, of how much pushback is he going to get, or at least internally from himself, as he starts to maybe see inflation increase.
The Trump is down 40K. Seema, don't you think that that's how the president thinks about things, that ultimately that his worst instincts are constrained by whatever happens with the equity market? That was the story in Volume 1. Will it be any different in Volume 2?
I think he keeps a close eye on the equity market. I think the position of Treasury Secretary is incredibly important. It was back then, it's probably more important even now. So I do think that he does take some pride in the performance of the equity market. And, you know, maybe that's another reason why we have some sense of confidence that we think that the policy will continue to reinforce a strong environment for risk assets.
Seema, appreciate your time. As always, Seema Shah of Principal Asset Management. We've been talking about this over the past week. It's why I think a lot of people in this market right now think we're moving towards, say, a Scott Bessent instead of a Ambassador Lighthizer for that Treasury Secretary position. Right, because Ambassador Lighthizer would likely be equity negative if you were put him into this top role. Maybe not so much as a tariff czar, but as Treasury Secretary. Also, I keep going back to the betting markets because I think the former president, future president, is looking at them. When he puts on his Truth Social and on Twitter the fact that Rick Scott, his maybe pick when it comes to Senate Majority Leader, Scott Bessent is far and away leading the crowd when it comes to the betting market. But overnight political is talking about other individuals like Gary Cohn, Jay Clayton, maybe, but it does look like there's a lot of coalescing around Mr. Bessent. Are we going to start quoting the Dow? We're not going to start quoting the Dow.
Not on this
Equity
program.
futures on the S&P 500 just a little bit softer. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Staying on President-elect Donald Trump, he tapped Elon Musk and Vivek Ramaswamy to lead a new Department of Government Efficiency. Yes, the acronym is DOGE, of course, referring to Musk's favorite cryptocurrency, Dogecoin. Trump announced the new department will slash excess regulations, cut wasteful spending, and restructure federal agencies. The president-elect said they will complete their work no later than July 4th, 2026. Meanwhile, the Federal Aviation Administration halted flights in Haiti by U.S. carriers for 30 days. This after Spirit Airlines, JetBlue, and American Airlines reported being struck with bullets while flying in the country. This comes as violence escalates in Haiti as gangs have seized parts of the country and politicians struggle to contain the violence. And we are seeing the Japanese yen weaken. It's currently trading near 155 against the dollar, a level we haven't seen since July. The move raises the risk that the Bank of Japan may intervene to try and slow the depreciation, since during the summer they intervened near these levels. The U.S. dollar has been strengthening against the yen and other G10 currencies since Donald Trump's re-election. Now investors are watching U.S. economic data for signs that the Fed may hold rates higher, a move that would further weaken the yen. That's your Bloomberg brief. John?
Yahara, thanks for that. Dollar yen at 154.89. Up next on the program, under surveillance, Biden and Trump reunited.
My predecessor made promises which he broke.
He is incompetent, ladies and gentlemen.
The only garbage I see floating out there is his supporters.
Now under crooked Joe Biden, the worst president in the history of our country.
The
The world is in flames.
That conversation just around the corner, live from New York City this morning. Good morning.
Politics to the world of business. Joe Matthew and Kaylee Lyons deliver news, insight, and analysis live every trading day. Balance of Power live around the world every weekday, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
New fund manager survey out from Bank of America in the last 24 hours. Michael Hahn and the team, the highest overweight to U.S. stocks since 2013. Take a listen to this. Post-election results show higher global and U.S. growth expectations, higher inflation expectations, lower probability of a soft landing, lower cash levels, higher allocations to U.S. equities. That's why we're very close to all-time highs on the S&P. Futures this morning down by 0.2%. Under surveillance, Biden and Trump reunited.
The threat that Trump poses is greater in his second term than the first.
The whole world is laughing at him. He's a fool. He's not a smart man. He never was.
My predecessor made promises which he broke.
He is incompetent, ladies and gentlemen.
My predecessor failed the most basic presidential duty.
Under crooked Joe Biden, every state is now a border state. Every town is now a border town.
The only garbage I see floating out there is his supporters.
Now under crooked Joe Biden, the worst president in the history of our country. The world is in flames.
So this is going to be great. President-elect Donald Trump making a dramatic return to Washington with a meeting scheduled this morning at the Oval Office with President Biden. Biden insisting he intends on doing everything he can to ensure a smooth transition to Trump's second term. Joining us now is Tobin Marcus of Wolf Research. Tobin, welcome to the program. We won't sit on this for too long, but I would like your view on what this transition might look like in the next few months.
So, look, I mean, we're seeing the Trump transition come together. They've been moving very, very briskly to get these jobs filled out. I think there are some picks that are pretty reassuring to investors. His chief of staff pick signals kind of an organized approach. Marco Rubio for Secretary of State is a pick that a lot of people cheered. But, we've also got some things that raise some eyebrows. Pete Hegseth for Secretary of Defense last night is something that I got a lot of concerned emails about from both Democrats and Republicans. So it's going to be a mixed bag.
Do you think he could get confirmed?
This is the first one that gives me that I have questions about whether or not he can get through the Senate. We haven't gotten a lot of clear signals so far about exactly how much willingness there is from some of these marginal Senate Republicans to stand up on these picks. And certainly during Trump's first term, he did have some of his more unorthodox picks end up going down. The rest of them I think are fine. But yeah, Hegseth is definitely one that is quite unorthodox.
Yes, and short-term memory, potentially people forget. Actually, John Radcliffe at one point was struggling maybe to get the nod when it came to the Senate in Trump 1.0. Tobin, you mentioned Senator Marco Rubio. This has only been leaked out to the press. Yesterday, last night, we got a slew of statements from President-elect Donald Trump about who he's going to put in certain positions. Why was that one missing?
Honestly, not clear. I mean, that's not one way, some of these, reports about people that have supposedly been picked, like Lighthizer for USTR, the FT reported that and then multiple other outlets denied it. I have not seen a lot of, sort of concrete pushback on the Rubio thing, casting it into doubt. So it's not one of the ones that seems really deeply under dispute. But, Trump is going to put these out at his own pace. Lots of people around him have made the point that until he says it with his own mouth or his own True Social post, you shouldn't take it seriously. But that one, I think, does seem fairly solid.
All morning, we've been talking about how the markets is reading all of this. Personnel is policy when it comes to a lot of this. Also, the makeup of Congress. We're having very slim margins in the House right now. And the Senate, of course, Trump may also pluck some senators out to join his administration. What do you think actually can get done in the first 100 days?
So in the first 100 days, I'm not incredibly optimistic. I do think things will take time. I mean, we'll see in the next couple of weeks how much of the decks they clear in the lame duck session. So they may or may not need to deal with appropriations for FY25, keeping the government funded through the end of the year in Trump's first 100 days, depending on whether or not they do that now. So, there's some routine blocking and tackling that needs to get done. The big thing Congress needs to do next year is this huge fiscal package that they'll do through reconciliation. There's been a lot of talk from Republican leadership about doing that in the first 100 days. That seems like a big lift to me. My guess would be that we see the wheels start moving on that in the first 100 days, but that ultimately the bill kind of comes together and gets fully enacted later in the year.
Will they be dragged down by the fact that they're going to have to replace some individuals like Congressman Walt of Florida and Representative Elise Stefanik of New York?
I don't really think so. It's sort of the difference between having a 1 vote and a 3 vote margin, which is, what hinges on having those two folks in place, I think is not really that big of a deal. Like, we're already in a situation and will remain in a situation all year where any group of Congress people in the House that have any willingness to hold together can tank these bills. The conservatives can, abstain. The moderates can abstain. So I think a lot of people have theoretical bargaining, power. The question is going to be who's willing to actually stand in front of Trump and sort of buck the team. And my guess would be that on these things where it really matters that they hold together, like a reconciliation bill, at the end of the day, the incentives for kind of cohesion and team play are so strong that they'll all come together.
Okay, so
the vacancies are also not that long. Stefanik might be gone for 90 days. Like that's, I think, manageable.
So on the good side of what the market's pricing in, you see this potentially getting done next year through reconciliation. What about some of the concerns the market has with something like tariffs? How are you reading the tea leaves?
Yeah, look, I think the tariff threat is quite real. I don't have any reason to think that it's going to be exactly 60% on China with no exclusions, or that he's going to do the 10% globally across the world, on a sort of sweeping basis with no exceptions. I think that a lot of this will be case by case. There will probably be differentiation of tariff rates by category. Some countries will get hit, some countries won't get hit. But that's still going to add up to a very material expansion of tariffs. I think it's going to be a significant event for markets, both from a macro perspective in terms of currencies and rates, and for a lot of single names. I do think it'll take time to come together. But, when we look at his rhetoric throughout the campaign, when we look at the likely return of Lighthizer in some role, I think there's a real sincere belief in the power of tariffs, not just as a negotiating tactic, but as something that you need to leave in place to raise revenue, to pay for taxes, tax cut extensions, and to, really reroute global trade flows.
Well, given that, Tobin, given the possibility of Lighthizer, given the announcements we've heard or are likely to get, they seem like China hawks, they seem like immigration hardliners. Does that give you a sense of what the focus will be for the first 100 days and maybe suggest that the market has gone too far in overlooking these things?
I mean, it was always our expectation coming into the possibility of a Trump win that we'd get kind of, sort of front-loaded good news in terms of the expectation of things like regulatory relief. And then, a longer timeline for some of the real risks to markets to come into focus in terms of things like tariffs, like elements of this tax bill that might be, sort of more adverse for certain sectors, like rolling back parts of the IRA. And I think that's what's playing out. So I think the trajectory makes total sense. This is not surprising. But yeah, those risks are out there. It's always been the case that, coming into this administration, particularly unlike the Trump administration, we don't have another 14 points to cut the corporate rate. We are kind of starting deep in a hole when it comes to the fiscal policy choices that need to be made next year. So I think it's going to be less sort of unequivocal good news for markets than his first year was last time around.
Tobin, what about the department of government efficiency, which is a task force, not a department. What sort of role do you see Musk and Ramaswamy playing over the next few years?
So ultimately, the thing here is that there is no shortage of ideas about how to make the government more efficient. The challenge of making the government more efficient is actually making the government more efficient. So putting these guys in this sort of external advisory role, I don't necessarily think is going to change anything very much or change their trajectory here. You know, when it comes to streamlining departments or reducing federal headcount, Congress generally needs to be involved in those decisions. And it's been the case for decades that attempts to do that have been stymied by congressional resistance to cutting budgets or, getting rid of these small programs that have some little constituency somewhere. When it comes to streamlining regulations, there's processes for doing that where generally you have to go through these pretty burdensome, rulemaking processes to get stuff off the books. So, I think there is some level of seriousness of purpose from Trump about those ideas, but like whether or not Musk and Ramaswamy are there advising him from outside the government, I don't really think is going to make that big of a difference.
Hey, Tobin, appreciate your thoughts. Thank you, sir. Tobin Marcus there of Wolf Research. The to-do list is super, super long. The amount of time we've got, like that much.
Right. They want to get this all done in 2 years. But going back to that quote-unquote department, which Danny rightfully called a task force or a council, a source was messaging me earlier this morning. It has no power, no authority, no money. Actually, it might actually create more bureaucracy in the U.S. government. All it's going to do is potentially send these recommendations over, but it needs congressional approval for any of these recommendations. So I think everyone is focusing on this brand new department being structured. It's not an institution. It's a task force or it's a council. And guess what? We've had tons of them through countless administrations.
I wonder if there's going to be a return to office recommendation pretty quickly, though, down in Washington, D.C.
That would have to come from the president-elect himself, not Elon Musk.
The recommendation might come from them, and then maybe acts on it, and then that starts this whole drama over who's in charge and, what this is going to look like.
There'll be a lot of memes.
There's going to be a ton of them. Coming up on the program, Earl Davis of BMO on why he's doubling down on U.S. risk. From New York City, this is Bloomberg.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, The moment news breaks, 24 hours a day. Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Equity futures on the S&P 500 slightly softer here. We're down 0.1% on the S&P. On the Nasdaq 100, we're down by 0.2% as we wait for some CPI data in America, about 60 minutes away. Let's get you some morning movers with Manus Cranny. Good morning, Manus.
Jonathan, good morning. Spirit Airlines looks as if they've run into real headwinds on doing a deal with Frontier. It's just too big of a bite for Frontier to take. Right now, it's a question of whether it's an equity holder's wipeout and a haircut for the bond holders. They're negotiating over about $1.5 billion worth of debt. Some of that is backed by the frequent flyer program. They never really recovered, did they, from the JetBlue blockage that Biden put in place. What is M&A going to look like in this space under Trump Mark II? There's something to consider. Roll it over, have a look at Rivian. When you want access to technology, which is what VW wants, and they need to stymie the cash burn, Rivian, Volkswagen comes in with $800 million. They're doubling down on their investment. So this is about a symbiotic deal for both. Just think about it. Electric vehicles, there's new headwinds potentially coming down the pike here in the United States of America. Demand is soft in Europe, and China has its own set of problems. The quid pro quo is they get the cash, VW gets access to that technology. Now, Spotify, it's not a banquet, but it is everything you can listen to for $12. That is what you pay every month. The stock is up this morning. Which would you choose? A Taylor Swift concert ticket at $4,000 or $12 a month to tune into Spotify? They're beating on the margins. They're beating on the subscribers. They're beating on operating income. And the gross margins for Spotify are 32%. Take me back to Wembley. Take me back to Blonde Ambition tour of Madonna. I'd pay up for that every day.
You're raging yourself, Manus. Appreciate it, though.
No problem.
Thank you, sir. Thank you very much. Under surveillance this morning, President Donald Trump making good on a promise to create a Department of Government Efficiency, or DOGE. Elon Musk will work with entrepreneur Vivek Ramaswamy to lead the effort. The group will partner with the White House and the Office of Management and Budget.
Ignore the hype. This is a task force or this is a White House council. Back in September, when this was actually floated, Terry Haynes wrote a note saying that this isn't bold or new in Washington. If you're on the Titanic as Trump infers and your top job is spending time rearranging the deck chairs, you're not poised to deliver anything transformative during your last and only 4 term in office. You're poised to waste time and job boning. This task force has no money, no authority, and no power. Sure, it can give us a bunch of recommendations. Elon Musk can also do that on his own platform, Twitter.
Honestly, what I'm hearing from you, Anne-Marie, is for everyone that's been bidding up Tesla, maybe curb your enthusiasm. If actually Musk's power is going to be much less in the White House, maybe some of the things that he wants to get done. I mean, he's complained about so many different government regulations. What kind of power will he actually have to change that?
He can recommend. He can make recommendations. There is something to be said for his access to power and the fact that, given the fact that this is not going to be a government department, he doesn't need to divest his business interests, but he can recommend policy that could impact and maybe help his business interests. So of course we're going to be critical and watchful of that, but we should really know, what kind of quote-unquote department this is. It's not.
This is going to attract a lot of attention over the next year, that's for sure. Elsewhere, according to the Washington Post, President-elect Donald Trump is looking to stop a U.S. ban on TikTok, the social media app facing a January deadline to find a new owner outside of China or lose its U.S. audience. The law putting the ban in motion passed Congress in April with bipartisan support, and this was widely expected. The pushback is going to begin fast.
The pushback is going to begin fast, maybe even with his own national security advisor designate that he has tapped, Congressman Waltz, who has called this in the past a Chinese spyware app. But I'm not surprised by this news. Former president, future president, Donald Trump has flip-flopped a number of times when it comes to TikTok. He was very clear with our colleagues in the summer in Business Week, and here's what he had to say. I'm for TikTok. You need competition. If you don't have TikTok, you have Facebook and Instagram, and that's Zuckerberg. So he already was changing his tune on TikTok. What's notable is the deadline is coming up, January 19th, so something has to be done.
Was this driven out of an anti-Meta, anti-Zuckerberg push, or is it driven out of something else? Does it come from somewhere else?
Well, he says it seems like it comes from this idea of competition. There's also a lot of people that talk about the fact that one of the future president's main supporters, main donors is an individual called Jeff Yass, who has a serious stake in this company.
It would be very upset if said company was forced to basically fold in the United States. Let's get you to the latest from Apple. Bloomberg reporting Apple is looking to launch a new product category, the company working on a wall-mounted display to control appliances, video conferencing, and AI. An announcement could come as early as March. The company looking to catch up to devices made by Amazon and Alphabet. It sounds a whole lot like a TV.
Except,
what we're expecting.
Okay, this is my big problem. It's 6 inches big. That's literally like
a mini TV.
No, that's like an iPhone, an old iPhone taped to the
ruler.
wall. That's not big enough. If you're across the kitchen trying to read something, they need to make the thing bigger. It should look like a TV.
You need to buy the glasses that they want you to have so you can see the tiny 6-inch TV that's hanging on the wall.
Every time I hear about the future, I don't like the future. Apple is down by a third of 1%. Let's turn to the US economy. Investors counting down to US CPI data due out in just under an hour. Earl Davis of BMO is unequivocally bullish US risk assets and is doubling down on the US being the global economic nucleus. Earl joins us now for more. So Earl, I think we should start there. Unequivocally bullish risk. The United States, the epicenter of the world. What's behind that, Earl? Walk us through it.
Well, as you know, Trump has said, we're going to have corporate tax cuts and deregulation, both of which are positive for growth. Now let's focus on deregulation. When you reduce regulations in business, what actually happens is you increase potential GDP. And with that increase in potential GDP, that becomes a magnet for capital. So you're going to have capital allocation increasing to the U.S. based on those policies alone. We've actually done this in our strategic bond fund, which is a global bond fund, where we've reduced our emerging market exposure and increased it with U.S. IG and high yield.
Oh, looking at high yield and IG right now, incredibly tight. Let's go to the price of the story. Investment-grade credit spreads, I think the lowest so far, the tightest so far this century. High-yield credit spreads around 250. What kind of tightness are you anticipating, Keir? How much tighter can those spreads get?
I won't even put a number on how much tighter they could get, but I've been in this business since 1994. And one of the things you always have to follow is the wall of money. It starts from the basics, how much money is out there and what are your investable assets. We know the wall of money is enormous because of QE and everything that's happened over the past 10, 15 years. And with now this policy coming about in the US, your asset base is limited now. So it's hard to put a price on it. I agree with the valuations are very tight. That's not why we're not all in high yield right now, but we are looking at any sort of hiccup, backup to switch from our IG to high yield. We believe we have about 2 months to do so. We want to ensure that we're positioned where we want to be positioned for January 1. I call it the year of hope because you're hoping for the best in all these policies and for what will happen before the actual details of them come about. But that's how we're approaching the market right now.
Earl, just to marry those two thoughts you have together, we've seen credit spreads get really tight despite the fact that there has been really robust supply. There's been a lot of issuance, but that issuance largely has taken the form of refinancing. Are you expecting to see another wave of issuance, but this time being driven by deals?
Yes. Well, deals for sure because of the nucleus. But also you have to think about this market environment. One of the things with this market environment, higher potential GDP means higher real rates, which means higher nominal rates. You add in the potential inflationary impact of tariffs, that also adds to higher nominal rates. So if corporations have rollovers coming, they will look to extend duration if they believe this higher interest rate environment is here to stay, at least for the next administration. So I think it not only will deals do it because of the economic nucleus and capital coming into the U.S., but also the outlook for interest rates as well will help the deal flow.
Well, the other obvious party to the issuance bonanza is the Treasury, Earl, and fears of a fiscal deficit that's ballooning at a time when the Fed is doing QT, when you have foreign central banks trying to pull back where they can from buying treasuries. Earl, are you concerned about the lack of price-insensitive buyers in this bond market?
No, I'm not. I'm actually concerned about the price-sensitive buyers. That's why our perspective in regards to risk assets and doubling down is not a 4-year story. It's not a 2-year story. It's a 2025 story. There's a lot of unknowns out there, and the unknowns are all around inflation. And, you know, you have the impact of tariffs. You have actually the tax cuts that will come about. How's that going to be funded? We're not expecting to see less deficit spending, so we know for sure that there will be more supply coming about, and that's one of the things in the back of our minds when we look at the risks to our outlook.
So, that takes us to treasuries. Do you think that's already contributing to higher yields across the yield curve, or do you think the move we've seen so far is largely off the back of better than expected economic data?
Yeah, you know what? Let me break down what I said before and why we foresee higher yields. You know, your nominal yield is made up of 3 things. It's made up of break-even inflation or inflation expectations. It's made up of your real rate, which is tips, and risk premium. So break-even expectations, we expect to stay in this, you know, gravitate to 2.5, staying between 2.5 to 3 until the details of the tariffs are out. That is inherently inflationary, both globally and domestically for the U.S. So that's one part that says higher yields. The next part, real rates, I spoke about before, is potential GDP. A neutral real rate reflects your potential. So if potential GDP is going higher, your neutral tips goes higher, and that pulls it higher. So that, again, higher nominal rates. And then you add in the unknowns of exactly what's going to happen, both from a treasury issuance perspective, as well as from a policy perspective, says you need risk premium. All those 3 things come together, push you or bias you towards higher yields.
Earl, I want to give you the chance to ask a question to a Fed official as well. We'll catch up with Neil Kashkari, the Minneapolis Fed president, about 8:35, 8:40 Eastern time, following the CPI data. What would you like to understand from them? What didn't you get out of the news conference with Chairman Powell that you'd like to hear just a little bit more about?
It's a good point, and they won't be able to answer the question. Obviously, we see some conflict between Powell and President Trump coming down the line, if there is some tension's a better word. The impact on that in an inflationary environment is very significant in regards to adding to risk premium. So my question actually would be, how do they gauge risk premium, and how do they gauge their impact on risk premium with the potential conflict in regards to who is the Fed chair? And that's a thing that we're looking at, our team in the background, and that's a thing that we think could lead to higher yields as well, too.
That's really smart. Earl, appreciate your time, sir. Looking forward to the conversation with Neil Kashkari, the Minneapolis Fed president, a little bit later. That was Earl Davis of BMO. That's a question that's going to be on repeat, like in every single news conference through next year.
Absolutely, because we do know from the first iteration of the Trump administration, he was jawboning Jay Powell on Twitter. Scott Bessent has talked about maybe putting a shadow Fed chair in with Powell. Trump has said he will not get rid of Powell if Powell's doing the right thing. Well, for Trump, that's what? Cutting interest rates. This is a real estate developer. That's how he views the world. But what happens if your tariffs drives inflation and the Fed has to potentially either cut the cutting cycle or hike? Then there's going to be a lot of jawboning and potentially some consternation.
We've introduced some real two-way risk in the last week for 2025, that's for sure. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Let's start with President-elect Donald Trump's latest cabinet picks. He has tapped John Ratcliffe to be the director of the CIA. Ratcliffe previously worked as the National Intelligence Director at the end of Trump's first term and served as a Republican congressman from Texas. Trump also nominated Pete Hegseth as Defense Secretary. Hegseth is a Fox News host and an Army National Guard officer. Both nominations need to be confirmed by the Senate. Meanwhile, the New York Times is reporting special counsel Jack Smith plans to resign before President-elect Donald Trump takes office. Smith is responsible for the 2 federal cases against Trump. One is an alleged attempt to overturn the 2020 election, and the other involves allegedly hoarding classified documents. Smith reportedly plans to complete the investigations before the inauguration. And Massachusetts Senator Elizabeth Warren is set to become the top Democrat on the Banking Committee. Warren, who just won re-election, will succeed Senator Sherrod Brown of Ohio as the panel's top Democrat after he was defeated last week by Republican Bernie Moreno. The role will position Warren prominently in an area she has been long outspoken about as a frequent critic of Fed Chair Jerome Powell, cryptocurrencies, and of course, Wall Street's biggest banks. That's your Bloomberg Brief. John?
That's a senator who might hate the next 4 years. Up next on this program, Disney rounding out Q4.
The combination of Disney Plus, Hulu, and then we're going to have an ESPN tile and ultimately ESPN flagship on our streaming service. That's a huge amount of value for consumers.
We'll get you a preview up next on the program. This is Bloomberg.
In case you missed it, on Bloomberg Technology.
We are very focused on playing one game and one game only, and that is being free, frictionless entertainment for consumers. But what I will say is we are doubling down on the strategy. We believe it's working. We think the tailwind's in our favor, and it's on us to continue to deliver.
Whenever you're doing something innovative that hasn't been done before, there's a lot of trial and error and iteration. It just always has these zigs and zags along the way, and I think where we've been successful is really being reactive.
Hollywood is the history of technology. Like, we are here because of technological breakthrough, right? And so we sometimes forget that art and technology kind of like come together always. And for us, it's like demystifying a little bit the technology. Again, if you understand AI as a tool for humans, then it changes the narrative. And it's less about fearing it and more about embracing it.
Don't miss Bloomberg Technology, live every weekday.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Equity futures on the S&P down by 0.2%. The bond market pretty stable here. The 10-year 4.42. Under Savanis this morning, Disney rounding out Q4.
What we've tried to do with our own offering is offer the individual pieces, or if people want to get a discount by bundling, we're happy to do that. The combination of Disney Plus, Hulu, and then we're going to have an ESPN tile and ultimately ESPN flagship on our streaming service. That's a huge amount of value for consumers. When you deliver that much value to consumers, consumers are willing to pay a little bit more because frankly, they're getting so much back in terms of entertainment.
So here's the latest. Disney gearing up for its final earnings report for the year. Robert Fishman of MoffettNathanson writing Disney has hardly been immune from the negative earnings revisions that have befallen the rest of the industry. But there is also reason to believe that those Disney headwinds are short-term in nature and the broader company may be at a turning point. Robert joins us now for more. Robert, welcome to the program. Let's identify those headwinds. What are they and what do you think are short-term about them?
Yeah, good morning. So really where Disney's at right now is needing to prove to investors that the DTC story is something that they can believe in and should believe in to get them excited about what that long-term opportunity is and to get the valuations more in line with how the company is actually performing. And I think often overlooked data point is that the Walt Disney Company as a whole, when you include their linear and streaming services together, is actually the biggest platform out there, according to Nielsen, ahead of YouTube, ahead of Netflix. So it's something that I think the company is going to continue to be focused on, and investors are clearly focused on in terms of valuing the company on the DTC side. But back to your question, in terms of the short-term headwinds, really what's going on right now is that investors need to feel confident that the parks have been de-risked. And what I mean by that is there's been a little bit of extra noise in the system right now after the COVID comps and with Epic opening ahead of Universal in May. So there's a lot of theme park focus right now, but we think that hopefully is going to start to be behind us now that we start focusing on DTC moving forward.
Robert, surely the other focus in this earnings is going to be the search for a new CEO. Wall Street Journal had a story out yesterday that they're looking not just internally rather, but outside too. Someone from Electronic Arts, their name was floated, as well as other people. Robert, does it make sense to bring someone up internally from the behemoth that is Disney, or look elsewhere?
I mean, that's the ultimate question for this company, and clearly with Bob Iger at the helm, they've done an amazing job leading this company. He's done an amazing job leading this company over his long tenure. But the question is going to be who can replace those big shoes to fill. And I think the company is clearly taking this process very seriously. I think they're going to look to, as you noted, explore all candidates outside and inside. Historically, the company has gone more internal candidates, but this is obviously a critical junction and inflection point for the company as a whole. So you need the right people to be able to lead that moving forward.
And we know James Gorman, now the chair of Disney, is largely leading that push. Robert, what does a Disney with the chair Gorman look like? What sort of changes do you expect to happen with him now having a large influence over Disney?
Yeah, I mean, I think just as you alluded to, given his history, he is very much focused on the succession process. He's been very vocal about that. And I think, as you just mentioned, really just exploring all the best candidates out there, whether that means internally or externally. I think it's going to be a very thorough process.
We've been through this story before, though, with Bob Iger passing on the baton and then taking it back. What has Disney learned from that experience?
I think, again, exactly to the point that it does need to be a broader search, and I think that it needs to be all-encompassing to explore all of the potential candidates and not just more of a narrow process that seemingly happened through the Chapek process.
You mentioned at the top that you're really looking forward to seeing how Parks is doing. We had Bank of America on yesterday with a consumer checkpoint, and they're saying people are really going out and spending on services. Do you see any of that starting to dwindle or even any impact from the hurricanes when it comes to the parks in Florida?
Yeah, great question. So yes, I mean, clearly the hurricane with Walt Disney World shut down for a couple of days. So that will impact, and we expect to get an update from the company about the potential sizing of that impact for their fiscal Q1, the December quarter. But essentially, after that number is known, we are hoping that the company can essentially reset expectations around the overall parks. Again, I mentioned Epic, which is Universal's park, is opening in May. So there's always ahead of a big competitor launch, some sort of noise in the system that happens, and we expect that the same, given the size and scope of Epic opening in May, that could have an impact on Walt Disney World. But once these factors are known, then we expect investors to get a little bit more comfortable with the trajectory from here.
And then you said, as you mentioned in your first answer, that we can concentrate on streaming, Robert. They turned to profit for the first time last quarter, their Disney Plus division. What are margins going to look like this time around?
Well, again, that's kind of one of the ultimate questions here for Disney, and investors need to have the confidence that this could look like similar margins to Netflix in the longer term. And the company has given us some building blocks in terms of how they're going to get there. They're clearly focused on a lot of the costs and the third-party distribution fees. So there's a lot that we've kind of dug into on the potential margin. A big piece of that is how they incorporate Hulu going forward, and we're awaiting the Comcast arbitration. So once that's behind us, hopefully we can get a little bit more color as to what the aggregate DTC services bundled together look like. I think you played the clip at the beginning, but we're really bringing Disney Plus, Hulu, and ESPN together. As I mentioned before, that combination allows Disney plus their linear channels to be the #1 platform in terms of viewership measured by Nielsen. So I do think that the company is very much focused on what they want to do with DTC. That there was a big new hire from YouTube that came over as part of their focus on the technology piece of it. So there's a lot that still needs to be evolved on the DTC strategy, and we're excited about where that can take us and ultimately where that leads to double-digit margins and beyond.
Robert, before you go, I just want to talk about the circus on Friday night. Mike Tyson, Jake Paul. How much money does Netflix make on something like that?
That's a fun question. So essentially, the way that Netflix, I think, is viewing this is an opportunity to, again, push their live programming. Clearly, it's a very high-profile event, as you just alluded to, and I do think it will help push them forward in the advertising realm, right? Because what this company, Netflix, is really trying to lean in on now is the higher engagement, higher CPMs for the viewership that they do have, and really kind of growing the ability and opportunity with sponsorships, and you know, they have WWE coming aboard. So this is just another step. And then again, with the Christmas games coming from the NFL, the focus is live events here.
Well, we're talking about it, so I guess it's working. Robert, it's good to see you. Robert Fishman there of Moffett Nathanson. Up next on the program, Kevin Gordon of Charles Schwab, Neil Dutter of Renmac. We'll speak to David Kelly of JP Morgan Asset Management and the Minneapolis Fed President, Neil Kashkari, right here in New York City.
One of the institutions you've been very philanthropic with is your alma mater, Harvard. But recently, you've been very public about your criticism of the way Harvard handled the events of October 7th and their aftermath. Could you talk about that now?
The first reaction of a group of 34 Harvard student clubs on the morning after October 7th was to put out a statement saying that Israel was 100%.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Thing you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more. It might shut.
So this can carry up to 20 people, and it can also transport goods. So you can configure it for goods transport within a city or transport of up to 20 people at a time. So this is going to, the Robovan is what's going to solve for high density. So if you want to take a sports team somewhere, or you're looking to really get the cost of travel down to, I don't know, 5-10 cents a mile, then you can use the Robovan. Some people call it the Robovan, but so yeah. You know, one of the things that we want to do, and we've seen this with the Cybertruck, is we want to change the look of the roads. You know, the future should look like the future. So, speaking of robots, so everything we've developed for our cars, the batteries, power electronics, the advanced motors, gearboxes, the software, the AI inference computer, it all actually applies to a humanoid robot. It's the same techniques. It's just a robot with arms and legs instead of a robot with wheels. And we've made a lot of progress with Optimus. And as you can see, we started up with someone in a robot suit, sort of down, and then we've progressed dramatically year after year. So if you extrapolate this, you're really going to have something spectacular, something that anyone could own. So you could have your own personal R2-D2 C-3PO. And I think that's this would cost something like, I don't know, $20,000, $30,000. Probably less than a car is my prediction long term. Now, it'll take us a minute to get to the long term, but fundamentally at scale, the Optimus robot, you should be able to buy an Optimus robot for, I think, probably $20,000 to $30,000 long term. So, and what can it do? It'll be able to do anything you want. So it can be a teacher, babysit your kids. It can walk your dog, mow your lawn, get the groceries, just be your friend, serve drinks, whatever you can think of, it will do.
Just a little bit on a 10-year 442.16 after a double-digit basis point move in yesterday's session. The 2-year anchored around 430. All of this going into CPI at 8:30 Eastern time. Then on to Friday when we get some US retail sales as well. And the one question I think we all have at the moment, what would it take to disrupt the easing bias of the Federal Reserve, and could that happen as soon as December?
Well, Neel Kashkari, who is not a voter at the moment, but did say that it would take a surprise on the inflation front. That is the thing that could change it. It's remarkable how quickly it's gone from the labor market being our top concern back to inflation. That CPI today is the thing that could really move the market. It wasn't that long ago where we basically looked over CPI and we were trading on things like weekly claims as the thing that mattered for this market.
When it comes to inflation, this is one part, this concern about resurgence inflation in 2025 based off the Trump trade. And we just heard from Earl Davis of BMO talking about an unknown implication of the tariffs. You look at what the Fed said, the FOMC had to say about Trump 1.0 and the trade wars. They said you have to look through the impacts. This is going to be a one-time hit to those price levels. Does that still continue? And does it depend on how big these walls are, how big those tariffs are going to be, 60% or not?
You mentioned Earl Davis. We've priced out a lot of Fed easing, and yet this equity market's still near all-time highs. Still near all-time highs because this data's been pretty good. Jobless claims, since you mentioned them, down by 220. 220 is really low.
Okay, but we had really big revisions in the last non-farm payrolls, and it was a month because of the oddities of the weather, because of hurricanes, because of strikes, that people basically just wrote it off, and they overlooked that. I just wonder, John, how quickly can this market flip again? If we start to get some bad labor market, are we going to go, okay, we went too far on growth, everything's wonderful, and now we're worried about recession again?
This narrative has already flipped 4, 5, 6, 7, 8 times in the last few months. Coming up this hour, we'll catch up with Kevin Gordon of Charles Schwab as the S&P 500 snaps a post-election winning streak. We'll speak to David Kelly of JP Morgan reacting to inflation data at the bottom of the hour. And we'll catch up with Minneapolis Fed President Neil Kashkari on whether that data might derail a December rate cut. We begin this hour with the equity market rally on hold as investors wait for inflation data following a repricing of expected rate cuts. Kevin Gordon of Charles Schwab saying monetary policy might be hamstrung in 25. Much of the policy landscape is still to be decided, but if deficits widen out aggressively, higher tariffs put upward pressure on inflation and immigration policy restricts labor force growth. It's plausible to see how the terminal rate might be raised. Kevin joins us now for more. Kevin, good morning.
Good morning.
And raising that rate may be for bad reasons and not good ones. Is that how you see things?
Yeah, and I think it's tough because, of course, this is all a guess at this point as to what policies are going to, be put in place. And the thing I struggle with right now is if you look historically, more sort of less aggressive Fed easing cycles, if they're not going at every single meeting or if they're not cutting by 50 basis points, that actually tends to be a healthier backdrop for the equity market. However, when you overlay all of the policy uncertainty, especially from a tariff and a labor perspective, I think that introduces another set of risks. And, the unfortunate part for the Fed, I think, you're talking about, risks to inflation, but also risks to labor. It's not that the headwinds for the labor market have just gone away automatically. It's the fact that now you have to start thinking about, and I do think it's early, but you do have to start thinking about the fact or the reality or really the possibility that you could be in a position in 2025 where there are still significant headwinds to labor, but then you have some reflationary forces building. And I think the difference now is from a labor standpoint in particular, if that comes via more restrictions on labor supply and you do get more of a sort of, fanning of the embers from a wage perspective, I think that becomes a little bit more of an issue.
Kevin, you know how this works. In moments of maximum uncertainty and low conviction, we all reach for a historical parallel.
Yeah.
We have a playbook. The first Trump presidency, how useful is that playbook?
In some ways it's useful. In some ways it's incredibly not helpful. And I think the useful standpoint, you could go back to, yes, maybe the obsession with using tariffs as a tool, the obsession of looking at equity markets in particular and how they react to them. You could use that as a playbook. On the other hand, the economic environment could not be more different. I mean, when Trump took office the first time, the unemployment rate still had more, to go to the downside. We were in that secular decline for the unemployment rate. You were in a relatively, healthy growth environment. You had 2017, which was basically the best year you could get for across risk assets where everything, was sort of low vol and everything was rallying. The volatility didn't start to show up until the following year. There's just such a different setup this time. So I think that, it is a knee-jerk reaction to go back to that one era and say, this is exactly how things can play out, but we're just facing a different set of circumstances. I would probably put more emphasis or most emphasis on labor in particular, because when you look at the gap that has been filled from a labor force perspective over the past 4 years, it has been from the foreign-born labor force. It hasn't been from the native-born labor force. So if you are putting some sort of restriction on that, or if you're taking a chunk of that out, not all at once, but phasing that in over time, that does put some pressure on the labor market from a growth perspective in terms of overall consumer spending and the power associated with it, but also from a wage and an inflation perspective too.
But to your point, we kind of have no idea what that's going to actually look at, like what form, what pace, what amount for all of the policies. So in the meantime, for 2024, before we have clarity on any of that, can you stand in front of this bullish train, or do you just want to hop on?
Well, I think that, momentum is a powerful thing. I was just looking at the S&P 500 Momentum Index. It's having its best year since 1998. It was since 1999, but now we've nudged up just a little bit more. So it's hard to fight against that trend, especially when you've got, close to 75% of members in the S&P trading above their 200-day moving average. Breadth has improved significantly down the cap spectrum, especially for the Russell 2000 in particular. So, it's on the one hand, I wouldn't want to fight the tape that way, but on the other hand, I think that you do have to some extent, start looking at these policy narratives that are flying around for 2025. And, I've yet to see a model that has not suggested that the tariff implementation as it stands right now, if all of it was to be implemented, would not be stagflationary, where you wouldn't get a hit to growth and you wouldn't get a boost to inflation. And that, to me, would be probably what comes first before you talk about the sequencing earlier, I know in the show, of, potential fiscal stimulus, but also potential tariff policy. from a unilateral perspective and not having to think about Congress, it would seem that everything unilateral from a tariff perspective probably comes first, and you get maybe some sort of fiscal aid later down the road, but that's also harder because you were discussing, the slimmer margin in the House that may be.
Which is why it's shocking the market is pricing in these tax cuts, which do we actually get them if you have a 1-seat, 2-seat majority?
Even this discussion about pricing things in, I find it hard to believe that over the past week the market is pricing in the next 4 years. I think, to me, just because the overwhelming consensus heading into the election was that it was going to be this drawn-out process where we weren't going to know who the winner was for several weeks, the fact that you got such a decisive result, I think the market really treated as a clearing event and took that huge, uncertainty chip off the table. So I don't think that we should be looking at, the moves over the past week and thinking that somehow suggests that this is what's going to be, the dominant market force, or these are going to be the dominant parts of leadership within the market. And, just as a sort of historical anecdote, if you go back to 2016, from election day to inauguration day of 2017, the parts of the market that were rallying and that were leading are similar to what has been leading this time. But actually, and the ultimate irony of it is that if you look at those groups and what their performance was in the following year, they ended up underperforming the so-called Trump losers, which lagged from election day 2016 to inauguration day 2017. So not to say that we get a perfect repeat this time, but I think you have to sort of take a step back as an investor and not get caught up in the election narrative and focus more on what macro forces are at play.
Does that mean that this is a great opportunity to take some profits in some areas, and where would that be?
I mean, we've been in the camp that, starting midsummer, that if you had seen some opportunities from the high flyers that had done really well, not just year to date, but over the past several years, and at that point it was more in the tech communication services parts of the market, then it made sense to do so, especially if you're more nervous about higher valuation and valuations just looking stretched in general. Those were a lot of the culprits, or a lot of the culprits were in those sectors. So it had made sense from our perspective to start adding into maybe, deeper cyclical areas that hadn't done as well. And, for sort of all of the stress associated with the aggressive move in the market over the past week and how cyclicals have really started to rally, a lot of those areas were doing well before. So it's not as if there was this massive leadership shift where you now all of a sudden have to be concerned about what might do well in the next several months because the election somehow changed it. That isn't the case. So I view that as a relatively constructive backdrop.
What do I do with the banks? Everyone's bulled up. Goldman's up by 54% year to date. Morgan Stanley's up by more than 40. I mean, pick a bank right now. They've absolutely ripped as well over the last week. What do I do with those names now?
I mean, the momentum is strong for a sector like financials. The breadth is strong for a sector like financials. For banks in particular, that's another area where I would be careful about drawing some sort of election-related, conclusion. Because, and again, I don't want to just look at the first Trump administration and say it's going to be a similar, or the repeat of what had happened, because the dynamic in the environment is different. But banks were the 6th worst performing sector during his administration. So it's not as if you can just say, oh, it's a pro-growth administration, or it's an anti-growth, or pro-regulatory, anti-regulatory, and tie that to what sector or what industry is going to outperform. So I would pay attention more to the underlying environment. And right now, things look relatively strong. I think a year from now, if we do start to see more material hits from tariff policy or immigration policy, then I think it's a little bit.
But when it comes to the banks, Trump is winning when there's a time where you see the regulators at play under a Biden administration. If Kamala Harris did win, do you think we actually would see these move in these banks?
Is the ultimate counterfactual. I think that regardless of who the winner was, I do think that if it was as decisive, if it was still as decisive, even if it went the other way, you would probably still have a similar reaction. Maybe not as strong in the bond market, but that still to me is a really interesting move. The initial knee-jerk move with the rise in yields and the rise in equities. You typically don't see that kind of move in equities if yields were shooting up that much.
And we can debate this because no one's wrong. Just by definition, we've got to look back and try and figure it out. At a guess, Harris win a blue sweep, a big Warren influence. I don't think Apollo's up like almost 20% in 6 sessions. I don't think you see that big run in regionals all for the banks.
Well, they would be doubling down on regulation, not this idea that the valve is going to open and maybe there will be this M&A activity of what Jane Fraser said. They're all game on, waiting on the sidelines and excited to get in.
I think Kevin's absolutely right, just clearing the event. Because the base case for a lot of people was this might take a while, and it didn't take a while. It was over by the time the sun rose the following morning.
It is quite remarkable to literally pull up any volatility index on any asset class, a straight nosedive down. That's basically a green light to say if you are a bull and you want to buy, you're an asset manager and you were scared of volatility, you can jump in now, and that's what we've seen.
So what we saw overnight. Kevin, it's good to see you. Overnight on election night, just straight down. Kevin Gordon there of Charles Schwab. Equity futures right now on the S&P 500 negative by close to 0.2%, with an update on stories elsewhere. With your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Donald Trump is returning to Washington. The president-elect is heading to the White House for a meeting at 11 o'clock Eastern with sitting President Joe Biden. They're scheduled to meet in the Oval Office, a ritual of the peaceful transition of power in the U.S., but one Trump didn't offer to Biden in 2020. Republican House Speaker Mike Johnson said it is likely Trump will go to Capitol Hill and meet with House Republicans ahead of his meeting with Biden. Meanwhile, U.S. dock workers and their employees are set to return to the negotiating table. Developments followed the three-day port strike last month. While an agreement was reached, including a 62% pay bump, additional issues were left unresolved, including one of the main sticking points, which has been around automation at the ports. If an agreement is not reached by January 15th, the second port strike could occur, making it one of the first challenges facing the new Trump administration. And SoftBank will be the first to build a supercomputer with NVIDIA's new Blackwell chips. The company will build Japan's most powerful AI supercomputer to support local services and will eventually create an AI grid that runs across the country. This was unveiled at NVIDIA's AI Summit in Tokyo. It's hosting events like this across the globe to support national efforts around AI and in turn lessening its reliance on a few large U.S. companies. That's your Bloomberg brief. John?
Yahara, thank you. I'm convinced NVIDIA has a summit every other week. Doesn't it feel that way?
It does, but
Jensen Huang speaks, the stock surges, it's another summit.
yeah, and we're like, what jacket is he wearing? How do we interpret that? It's leather. Okay, we're all bowled up. Great.
Dan Ives has called him, what, the rock star of semiconductors.
He's the godfather of AI. I think Dan Ives has got a lot of names for a lot of people. Up next on the programme, the Morning Calls Plus, Neil Dutta of Renmac, as we count down to CPI at the bottom of the hour. That's next. You're watching Bloomberg TV.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Always on the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Inflation data, 8:30 Eastern Time. Equities going into that just a little bit softer. We're down 0.2%. Some welcome stability in the bond market. The 10-year, 442.75. Let's get you some morning calls. First up, Evercore downgrading Caterpillar to underperform, saying Donald Trump's policies will have wildcard implications. That stock is down by 1.5%. Your second call from Redburn Atlantic, downgrading Starbucks to sell, pointing to uncertainty over future sales growth. That stock down by another 1.3%. And finally, TD Cowen lowering its price target on Spirit Airlines to $1 with debt restructuring talks underway. That stock collapsing. October CPI due just moments from now. Bloomberg Economics expecting the print to move, quote, sideways at best and hot at worst. Anticipating the price of core goods likely rose thanks to higher demand for cars and auto parts after two major hurricanes, Helene and Milton. Joining us now to discuss is Neil Dutter of Renmac. Neil, welcome to the program, sir. Let's just start with the inflation data in just a moment because we've got tons to talk about. What are you and the team expecting?
Well, I mean, I think the consensus is around 0.3. You know, John, one of the things I've always sort of stressed is, you know, these numbers, they ebb and they flow, but you have to have sort of a fundamental sort of framework for how to think about inflation. And what you don't want to do is put so much emphasis on one data point without being able to kind of explain the fundamental drivers for why inflation is turning up. And I think what's clear is that the labor markets are not really sending an inflationary impulse at the moment. And so that, to me, leaves me sort of more confident, I think, on the trajectory of inflation, even if you do get a hiccup here and there. I mean, we know from the employment cost index that wage and compensation growth continues to slow. We know that quits are down, which means that, you know, you should expect wage growth to continue to moderate. So when you think about inflation, it's really that triangle model, right? It's expectations, it's supply chain issues, and it's the labor market. We know that, you know, inflation expectations are broadly anchored, and we know that labor markets aren't really sending much of an inflationary impulse. So I think that probably puts us, you know, on a path to 2% inflation. You know, hurricanes, you know, we get a one-off sort of shock, okay. But ultimately, if wage growth is cooling and prices for one thing go up, then people have to cut back in other areas, ultimately driving the prices for those areas down.
Neil, can I just ask you about goods inflation as well and the prospect of maybe some upside risks in the not too distant future? I imagine people are going to pile into durable goods over the next few months, worried about tariffs. How are you thinking about some of those forces through the next several months?
Well, I think it's a wash in terms of GDP. I mean, if you have people boosting their imports to front-run tariffs, that's largely going to show up in inventory. So the imports will be sort of a drag on GDP growth, and the inventory investment and boost will be a boost. So I don't, you know, I don't really think much of it one way or the other. I think it just pays to focus on domestic demand.
Neil, it's pretty remarkable how quickly the market has moved on from a fear of a weakening labor market. Did we move on from that too quickly? How big of a risk is it still?
I think it's a meaningful risk. I mean, you look at the NFIB survey that came out yesterday, more small firms are complaining about poor sales as their biggest problem. And so historically, that's coincided with increases in the unemployment rate. You know, if you look at the broad scope of the labor market statistics, you know, the unemployment rate being at 4.1%, that's more the outlier than anything else. I mean, things like the quits rate, the hires rate, the rate of job creation. I mean, these are sort of more consistent with the unemployment rate somewhat higher than 4.1%. So I don't think we're out of the woods yet. I do think there's also some weaker GDP growth coming in the pipeline. You know, it's going to be very difficult for consumers to sustain this 3% real consumption pace that we've seen, given how weak income growth has been. We've already started to see non-residential business equipment spending begin to moderate. We know that Boeing is having trouble over the next quarter or two. So you have weaker consumption, weaker equipment, and oh, by the way, the housing market's flat on its back. So, you know, this is an economy that might be operating at a high level. You know, on the surface, things look okay. But I think underneath the surface, this is a relatively imbalanced economy with some downside cyclical momentum.
Well, you cited one of the sentiment surveys, but Neil, a lot of other ones we've gotten, both from the different government agencies, from the Fed, and from Bank of America, have been so strong. This from Bank of America's investor survey, 63% now think that the U.S. economy will stay robust. When they surveyed them in September, it was only 18%. Neil, did Tuesday change anything in terms of the likelihood that this economy can keep chugging on?
Well, look, I mean, I think that there is something to this idea of like the Trump confidence fairy sprinkling dust over the financial markets. But I also think it just it's prudent to kind of step back and think about what we're dealing with. The majorities in Congress that the Republicans will have, particularly in the House, are very thin. There is no Paul Ryan waiting in the wings with a plan ready to go for the Trump team to implement, okay? So I'd be dialing back the enthusiasm somewhat. And I do think that, look, I mean, the last administration probably went to the fiscal well one too many times, and that kind of constrains the choices that the Trump team has. So those expecting this kind of big bang sort of like tax cuts and fiscal spend, I think that, I think that that's going to be challenged somewhat. So in my opinion, I mean, I think it's only a matter of time really before the bond market kind of goes back to thinking about the underlying data. And, my sense is that fixed Yeah, of course it would be. I mean, we saw this play out in the last administration, right? I mean, the first year he was the market's best friend because the entire momentum legislatively was basically for the Tax Cut and Jobs Act. Once that passed in early 2018, there was a pivot to taking on a more hawkish approach to China with tariff and trade policy by tweet. And we know that every time that there was something announced, or some kind of hawkish trade thing coming out of the administration, the markets generally sold off on that news. So to me, I think it's important for people to think about the sequencing. If the first year is more about deregulation and tax cuts and, what can they get done legislatively, that might be sort of more positive for markets. But if that's only used to then pivot to trade, then that'll be negative for markets. But all else equal, sure, tariffs are not a good thing for the companies that trade on the S&P 500, many of which are global in nature. And we know that if there are tariffs, that might invite retaliatory action from other countries where they're doing business.
Neil, always great to catch up with you, sir. Neil Dutta there of Renmac on the latest for policy over the next 12 months. Sequencing is something we talked about a few times already this morning. Super, super important. The guiding light for that is basically cabinet positions, who gets what. And if you get a Scott Bessent in Treasury, I think it gives the signal to the market that things are going to have the kind of emphasis that Neil described at the end there, deregulation, a push for tax cuts, etc.
Absolutely, and potentially that will be the push and pull between a Bessent and a Lighthizer, who the Wall Street Journal is reporting that maybe will be this tariff czar. You'll have someone on the other end also looking out for Wall Street, S&P 500, Dow Jones. What is this exactly going to mean for U.S. companies?
Good cop, bad cop. It's like Larry Kudlow back in the day.
It's on the shoulders, the devil and the angel.
The director of the National Economic Council all those years ago. Up next on the programme, breaking CPI data. David Kelly of JP Morgan joining us around the table. And then the thoughts of Minneapolis Fed President Neil Kashkari here to react from New York. Your data up next.
the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Inflation data in America are about 20 seconds away. Equity futures on the S&P 500 going into that a little bit softer. We're negative by 0.2% on both the S&P and the Nasdaq 100. In the bond market, resetting higher in the last 24 hours on a 2-year and a 10-year. Yields higher across the curve in yesterday's session. Just about unchanged today. The 10-year 442, the 2-year at 434.67. With your CPI data this morning is Mike McKee. Good morning, Mike.
Good morning. Well, right now, it looks like we're pretty much bang on the consensus. 0.2% rise on the CPI headline number, 0.3 for core. We'll have to see what the unrounded numbers are. That may make a difference to the markets. On a year-over-year basis, 2.6% for CPI headline. That is as forecast, and 3.3% for CPI core on a year-over-year basis as forecast. So essentially, we can say that economists did a pretty good job of forecasting it this time. Whether or not it makes a difference to the Fed is a whole other question.
It makes a difference to the market because inline at the moment seems to be a beat, kind of better than expected. It wasn't bad. Equity futures on the S&P 500 higher by 0.1% after going into the print, down by about 0.2%. The Russell, the small caps, up by more than 1 full percentage point off the back of this. Danny, bond yields just a little bit lower. We're down 5 basis points on 2s, a break of 430. On a 10-year, we're down about 6, a break of 440.
It's not enough to undo the some 12 basis points that we pushed higher yesterday, but it's unsurprising to see some relief in this bond market where essentially we've been moving in a straight line up. This is a market that wants a reason to rally. I don't know how long this lasts, John, because back in the minds of all the bond market traders right now has to be, even though CPI looks good now, what does it look like in 2025 with a different set of fiscal policies?
Mike McKee, is there good reason for that relief this morning? When you look through the breakdown of this data, is there good reason to have that sigh of relief?
I haven't looked far enough into it to see where the weighting it comes in, but shelter prices were up 0.4. They were up 0.2 in the prior month. So there's a significant increase there, and the Fed is kind of looking through shelter prices at this point and OER, et cetera, because it has slowed down so much slower than anything else and than they expected. But we're also seeing the expected drop of 0.9% in gasoline prices. Utility gas down up 0.3 though. Right now, new cars were flat, but used cars up 2.7%. There's a seasonal aspect to that, and there's a hurricane aspect to that, because everybody's cars got wiped out during the hurricane. People first go buy used cars. I need something to drive, and then we may see prices go up for new cars coming forward. But it looks like across the board, there are general increases in everything. We're not seeing very many declines, and so it does show that at least inflation is kind of leveled out, if not going up.
Does that mean that a cut in December, that's straightforward now that we have this inline result with us?
No, not at all. And the reason being, we have another CPI report coming out and a PCE report, and we also have that labor report at the first of the month. So a lot of data between now and then. Jay Powell made that case that no one number is going to be determinative because there's a lot of data between now and the next Fed meeting.
Mike, you're going to stay with us. Joining us now is the JP Morgan Chief Strategist from JP Morgan Asset Management, David Kelly. David, good morning to you. Your thoughts on this? Are we on course for a rate cut in December?
I think we probably are. I think the key thing here is the Federal Reserve is not going to assume or speculate or predict what policy on tariffs and fiscal policy is going to be. I think they've got an idea where we're headed here, but they're just not going to put it into their thinking. And I don't think they want to pick a fight at this stage. They're going to have a fight at some stage with the administration, but I don't think they want to pick it right now. So what I think they'll do is, the markets are pricing in a quarter point, so if markets are pricing in a quarter point, they'll do the quarter point. But I will say that markets at this stage have only priced in 2 more rate cuts next year. And so the markets are stopping short of the dot plot. The dot plot says the Fed keeps going another 4 rate cuts second half of next year, early 2026. And the market's saying, look, given this agenda, the different pieces of this agenda, there's going to be too much inflation potentially in the system and too much debt growth in the system to really make that a rational policy.
The Fed does not speculate, the market does, yes, which explains the daylight that's opened up over the past week or so. Would you endorse that daylight opening up? Do you think there's good reason for it?
I think the way that both the stock market and the bond market have acted is logical. I think the assumption is that we're going to get a big fiscal stimulus. Now, it's going to have to go through the reconciliation process because they don't have 60 votes in the Senate. So I think this is going to be a slow-moving train, and everybody's going to be piling tax cuts on throughout next year. And so when it hits in 2026, it's a lot of fiscal stimulus and just huge, massive deficits rising over the next decade. I mean, it is a really kind of scary thing. But that's not there yet. But what's going to happen over the next year, the thing that's really important here is tariffs. Just how aggressive and how quickly do we follow this tariff agenda? Because the early smoke signals suggest that the new Trump administration is going to be very serious about putting in big tariffs fast.
Well, the market has decided to look through it and say maybe we don't expect indiscriminate tariffs, that it'll be more selective. If you look at a market like that and you're concerned about it and you're concerned with some of the appointments, do you want to push back on some of this market pricing then?
Yeah, I think I would be nervous just in terms of where people's portfolios are, because if people have not rebalanced, they are now way overweight U.S. equities, or way overweight mega cap U.S. equities. So the market has not only got richer, but it's also got more and more unbalanced over time. So I think this is a real time to think, look, we've moved from election uncertainty, that's over, to policy uncertainty. And there is a lot of policy uncertainty. And I agree with you that the first smoke signals suggest that the tariff approach is going to be very aggressive. But we'll have to see, because there are people in American business who have got huge interests in not being too aggressive here. You've got trade agreements you've got to deal with, and you're pushing up the price of stuff coming in. Everybody likes a tariff on their competitors, but there's also going to be tariff on your suppliers, and I think that could there's going to be a lot of conflict over these tariffs.
Well, in terms of the uncertainty, personnel is policy, and so far, Lighthizer has not been given the nod to go over to the Treasury Department, which many would view as antagonistic and aggressive in terms of tariffs. We had tariffs, though, in the first iteration of Trump. The Biden administration kept some of those tariffs on. Do you view them as a one-shot hit to inflation, that potentially you see an elevated price level, then you can look through it? Or do you think this could continue when it comes to reacceleration of inflation?
It probably continues, because, if you punch somebody in the nose, guess what? They're going to punch you back. And so if we put on tariffs and they put tariffs on us, and then we say, I can't believe they put tariffs on us. We're going to put a bigger tariff on them. Well,
so it's an ongoing cycle.
Well, that's why they call it a tariff war. You don't just get to unilaterally attack them, put tariffs on, expect nothing to happen to you. So and by the way, it's not just on inflation; it's also on growth, because we export $2 trillion worth of goods in this country. And all of that is going to be a target now for countries around the world. Say, well, you're going to put a tariff on us, we're going to put a tariff on that.
Isn't that a bigger problem for Europe and China than it is in the United States, relatively speaking?
Well, yeah, because we're on a trade deficit. So yes, it is. But a tariff for a tariff will make the whole world poor. It is. There are very few things that are sort of a stagflation elixir that can actually push inflation up and slow the economy down at the same time. I mean, I say this as an economist, and I think almost all people who've been trained as economists over the years realize that both academically, in theory and in practice, tariffs tend to slow down global trade. They make domestic economy companies inefficient, and they push up inflation. And they also push up inflation on lower-income individuals, because lower-income households buy more goods. Upper-income households buy more services. This is going to be on goods.
It sounds incredibly bearish, but you also started out with saying that the market's moves have been logical in stocks?
Well, yes, because there are offsets for stocks. One of them is that we could get a further cut in the corporate income tax, and that has a huge impact on earnings, and nothing is more important for stocks than earnings. So if you do see a reduction in the corporate income tax rate from 21% to 15% for domestic production, that could have a big impact. And of course, one of the other things people are going to be debating is, well, can I call this production? And so there's going to be a lot of debate around that. But I think those tax cuts for corporations will be positive for the stock market.
Libby Cantrell of PIMCO had a note about this last night, talking about how historically low and slim the margin is going to be for the Republicans in the House. No one can take a day off. The President-elect Trump might need to be careful who else he tries to pull from Congress to join his administration. Do you have conviction they will actually get that 15% tax cut?
Quite possibly, because I think you've got to look at. I mean, I think that I'm not a political observer, but it would seem to me the Democrats are pretty dispirited here. This is what the people have voted for. And
you think Democrats will sign up for a 15% corporate tax rate?
Well, they don't have to. In the House, you've just got to get 50%. And it looks to me right now, if the vote stopped today, it would be 222 to 213. So that's 9 seats. That's enough to get that thing through.
David Kelly, a lot to look forward to over the next several years. It's good to see you, sir. Thank you. David Kelly there of JP Morgan Asset Management. If you are just joining us, welcome to the program. Inflation data out just moments ago, in line with expectations. CPI month over month coming in at 0.2. Stripping out food and energy, that came in at 0.3. As expected, the median estimate in our survey was 0.3. The equity price action off the back of it on the S&P, up by 0.2%. On the Nasdaq 100, up by 0.1%. The outperformance on the Russell, the small caps, up by 0.8%. As you'd expect with this move in the bond market on a 2-year, 10-year and 30-year, yields lower across the board. The 2-year down by 8 basis points, the 10-year down by about 5 basis points. On the 30-year, we're down by about 3. If we check out foreign exchange, switch on the board and get to FX, we can look at where the euro is right now. We are trading just a little bit more positive off the back of that data, 106.43. I'm pleased to say that responding to this economic data now is the Minneapolis Fed President, Neil Kashkari. President Kashkari, good morning. Good to see you again.
Good morning. Good to see you.
Great to catch up. I saw some comments from you yesterday, and for our audience that might have missed them, I'll share them with our audience now. We can pick up on them. There'd have to be a surprise on the inflation front to change the outlook so dramatically. If we saw inflation surprises to the upside between now and then, that might give us pause for December. It'd be hard to imagine the labor market really heats up between now and December. That's just not that much time. Inflation data out just moments ago. Anything in that to disrupt this easing bias that seems to have gripped the Fed over the last few months?
First of all, it's very fresh data, so I haven't had time to go through it in a lot of detail. But at least on the headline level, it seems to be confirming the path that we're on. We've made a lot of progress in the last year or so, bringing inflation down. I need to go through the components of that release, which I have not done yet. But generally speaking, goods inflation is back down to where we want it to be, where it was pre-pandemic. Services inflation, which is tied to wages, is gently trending down. And then finally, housing inflation, we know, is a lagging indicator. We know that it takes a couple of years for the new leases to turn over, and the new leases are showing that we're headed in the right direction. So right now, I think that inflation is headed in the right direction. I've got confidence about that, but we need to wait. We've got another month or 6 weeks of data to analyze before we make any decisions.
One of the things that has been very noticeable over the last week is the change in investors' views about where you're going to end up. If you're looking at SOFR futures, right now, they only price in about 75 basis point cuts between now and the end of 2025. Are we entering a period, because we don't know what Donald Trump's policies are actually going to be, where the dot plot, the summary of economic projections are kind of off the table, can't really put a lot of faith in them, and that maybe you're in the Lael-Brainerd attenuation phase where you slow down everything and people should expect not a lot of guidance from the Fed?
Well, the dot plot is something that at times, I'm glad we have it, and at times it's more of a frustration that we have to fill it out because there's so much uncertainty about the economic outlook. Over the past year or two, I've been surprised at the resilience of the U.S. economy in the face of seemingly quite high policy rates. Yet the labor market has stayed strong and the economic growth continues to surprise us. So for me, I've been asking questions about where's the neutral rate for the last year or two. That's not about the election. That's just about how the economy has been performing over the past year or two. And so, for example, there's been revisions that suggest that productivity is now higher than it had been in prior years. If that higher productivity environment is maintained, that would tell me we're probably in a somewhat higher neutral rate environment. again, that's not about the election. That's just about how the economy has actually been performing. And so for me as a policymaker, that's what's leading to my own uncertainty about where is our ultimate destination. And I think that people are raising questions about what is the new administration going to do? What is the new Congress going to do? I think that's also adding uncertainty about ultimately what's the growth trajectory of the U.S. economy.
Well, Tom Barkin said yesterday, your colleague from the Richmond Fed, that right now there's no way to know. So one has to just kind of assume that things are going to be maybe stuck, inflation stuck above 2%. Would you join in that sentiment?
I'm not sure that I'm ready to say that inflation is stuck above 2%. I think it's right now running in the mid-2s on a PCE basis. And as I said earlier, goods inflation is back down. Services inflation is tied to wages, and wages are gently trending down. And housing inflation, we know, is going to take a couple years before the new leases roll all the way through the housing inflation. So I have confidence that inflation is headed in the right direction. Is it headed there fast enough? Do we want it to get there more quickly? You know, we will see. But ultimately, that and the labor market are going to guide our policy decisions.
Well, back in September on the labor market, you said that the balance of risk had shifted towards a more weakening labor market. Do you think we've backed off that risk? Is it not as acute as it was since we've had the data since September?
Yeah, we had seen some data piling up until that September meeting, which was pretty much pointed in one direction, which was a softening labor market. We then had a surprise on the other way. The labor market looked stronger, but then a reversal in the subsequent job report. And so I still think the labor market is softening. A 4.1% unemployment rate is a good unemployment rate. It's a good labor market. It's not as tight as it was a year ago or 2 years ago. So it's unquestioned that it has been softening. And right now we're at a good place in the labor market, and we want to keep it there. You know, I do a lot of outreach to businesses, large and small, around my region, as well as labor unions around my region. Generally, what I hear is cautious optimism. People feel good about the outlook, but there are some trends that it's slowly softening, and we just want to watch that carefully.
Neil, the election. We've got to talk about the election. And I know it's a difficult moment for the Federal Reserve. I think it's a difficult moment for monetary policymakers worldwide, for that matter. The chairman dealt with it in the news conference and was pretty clear. We don't speculate, we can't make assumptions. But you're in the risk management business, and you've been in the risk management business for a long time. It predates your experience at the Federal Reserve. Do you think we've introduced two-way risk in 2025? And when you think about the balance of risk, does that call for a slower approach to any move in monetary policy, one way or the other?
Well, two-way risk, I think we've already had two-way risk. So we've got risks of the labor market continuing to soften and over-softening, and then we've got risks of inflation potentially getting stuck. I'm not seeing a lot of upside risk yet. We don't know what's going to get enacted. I'm not seeing a lot of upside risk that inflation is going to take off from here. The bigger risk that I'd be concerned about in the inflation front is just if we're landing at around the 2.5% level instead of back down to 2% level. I think that those risks existed before the election, and I think that there continues to be uncertainty now, and we need to just take our time, let the data come to us, and let that guide us. Ultimately, for me, this goes back to the discussion we had a moment ago about where's the neutral rate. There's tremendous uncertainty in my mind about where the neutral rate is, and the longer the economy continues to exceed expectations, the more signal I take that we must not be as restrictive as I would have assumed.
Fed staff analyzed, though, during the first iteration of Trump, the impact of the tariffs, and everyone coalesced around this idea that there was a one-off increase in inflation. You can look through it. It wasn't going to be this vicious cycle and ongoing inflation threat. Did you agree with that assessment at the time, and do you still think that that's what tariffs could do in terms of inflation?
I agree with that assessment at the time. I still agree with that, but I think your prior guest touched on it, which is it really depends on what the other countries end up doing. If there ends up being a tit for tat and one country raises tariffs, they respond, and you go back and forth indefinitely, that could lead to a longer-term imprint on inflation and potentially inflation expectations. And of course, we don't know what our own tariffs are going to be, let alone what other countries are going to respond with. And so we just need to be patient and see.
I had a note come in from one of the Wall Street analysts that had a line that I thought was really valid, and that is that if you're going to forecast inflation, you have to have a theory of inflation and what's causing inflation. We've got relatively strong labor markets right now, and we've got concern about inflation. Real interest rates just keep rising, and they're working in opposition to your rate cuts. What's your theory of inflation, and how come we're seeing this kind of real rate reaction?
Well, I've done a lot of soul searching on why I missed the inflation run-up in the first place. I was surprised on the run-up. I was also surprised on the disinflation that followed it. And the one thing that's been constant is it was not the labor market on the run-up or the disinflation. It was mostly supply factors. And so, supply chains got gummed up. It took a lot longer to resolve. The inflation took off. You had the war in Ukraine also pushing inflation up. And then many of those factors unwound or didn't get worse, bringing inflation back down. So monetary policy's role, in my judgment, in this episode, has been to keep long-run inflation expectations anchored. And it has provided some gentle cooling to the labor market. I don't think the supply factors are what have caused the labor market to gently cool. I do think monetary policy has been doing that. And so you put all that together, it says that when I thought we were applying 2 feet on the brakes of the economy with monetary policy, we might only have been applying 1 foot on the brake. And so this goes back to where ultimately are we going to settle? We're going to have to let the economy guide us.
We are now paying as much attention to CPI again as we are to the labor market, but the labor market comes up in early December. We had a really, really strong September and a really, really weak October. Where is the labor market as far as you're concerned?
I think the labor market is in a good place right now. Again, the anecdotes that I get, I look at the data, the official statistics, which always have uncertainty. There's even more uncertainty about the labor market statistics, not just because of the hurricanes and the Boeing strike, but because of the large immigration flows, which we're not exactly sure how big they are, and they're time varying. So what is this month's break-even level of job growth? Your guess is as good as mine. So I look at the official statistics, and then I marry it to what we're all hearing, my colleagues and I, from all of our contacts around the country. The labor market right now is strong. It's a healthy labor market. Jobs are available. Businesses are feeling good. We want to keep it that way. And so as we get the data in, I'm going to continue to do my own outreach, and all of the other presidents are going to do their outreach to the businesses, large and small, and labor groups to get a sense of, is the labor market cooling slowly? Is it heating up? Or is it cooling quickly? And those will be important judgments into our policy deliberations.
Your former colleague, Bill Dudley, wrote a Bloomberg opinion piece earlier this week, basically saying that there's this possibility that Trump enacts policy quickly and forcefully in a way that doesn't give the Fed enough time to respond and without the proper tools to respond. Is that a concern you also share?
I think fiscal policy is always an input into our deliberations and into our analysis and assessment of the economy. I don't think that's new now. And it's not just U.S. fiscal policy. It's what happens with other countries, what happens with our trading partners. And so that type of uncertainty, we're used to dealing with it. Obviously, we would like to have less uncertainty. That'd be great. But it's the world that we live in. And we will take all the information we can as we get it and incorporate it into our thinking.
Speaking of uncertainty, there's been a lot of concern about what Trump 2.0 would mean in terms of jawboning the Fed and how he felt about Jay Powell. The FOMC had this plan during the first iteration of Trump that maybe they even move Powell to chair of the FOMC if he was going to take over the chairmanship of the actual Fed. Would you basically all act as a group to potentially thwart anything that was coming at you that would negate the Fed independence?
We are all committed to our dual mandate goals. Everybody around the table, all of my colleagues, stable prices and maximum employment. So number one, we're all committed to those goals. Number two, I don't think those goals are controversial. I think everybody across the political spectrum wants us to get inflation all the way back down to 2% and wants to keep a strong labor market. So I think that also provides us a lot of support. And then there's built-in continuity into the structure of the Fed that Congress designed. Governors serve up to 14-year terms. The presidents are independent, the presidents of the 12 reserve banks. These structures help us provide continuity. I'm confident that between the people who are there, our commitment to our dual mandate goals, and the structures that are in place, I'm confident that we will do the right thing and focus on the economy.
The housing market, how do you explain what's going on? The fact that prices aren't coming down, and if you keep rates higher than anticipated, we've already seen mortgage rates go up since you started cutting. Is the housing market dead?
Well, the housing market, as I've studied it, and this is an issue all around the country, the lack of affordability, not just for low-income workers, but for middle-class families and more. It's really one that we've underbuilt housing for the last decade. Following the great financial crisis, we just structurally underbuilt housing, so there's, in a sense, a shortage. And as I think about, back to the notion of a neutral interest rate, think about a neutral mortgage rate. If we have structurally underbuilt housing, and there's a lot of demand for housing, what interest rate is going to clear that market? All else being equal, you would think a higher interest rate would clear that market. And so I think the housing market has its own unique dynamics that are going on that are driving this more than just the macroeconomic landscape and more than just monetary policy.
So the Fed raises its hands and says it's not something we can fix?
Yeah, we can fix it. I mean, if we said we're going to cut interest rates to try to support housing affordability, setting aside the rest of our goals, what would that probably do? That would probably push up the price of housing. And so would that actually improve affordability? And so I don't think monetary policy is well suited to address the structural issues that are going on in the housing market.
We've touched on absolutely everything. Can we finish on financial markets?
Sure.
You know them well. Are you worried about cutting into an asset bubble?
You know, I always go back to when then Chairman Greenspan in 1995 declared irrational exuberance.
Sure.
1995 he declared it, and the stock market went up for the next 4 years. I look at that episode and think if the Fed had tried to use monetary policy to address that bubble, it would have done more harm to the economy than the fairly mild recession that followed when the tech bubble burst. And so I just think monetary policy is the wrong tool to try to address asset bubbles.
Do you think there's something that needs to be addressed?
Well, you know, bubbles are easy to spot in hindsight. If we really are in a higher productivity environment, if we're in a higher growth environment, and corporate earnings are going to continue to climb, one might look back and say, hey, these asset prices are not irrational. So it's hard to judge right now. If I knew where productivity was going, I'd be able to give you a more definitive answer.
Just looking at markets right now, equity is very close to all-time highs. We've got credit spreads that are at incredibly tight levels. For investment grade, tighter than anything we've seen so far this century. For high yield, I think you've got to go back to pre-GFC. And you know what happened next? We're cutting interest rates into that. We have authorities down in Washington, D.C., a Trump second administration that could be cutting taxes going into that as well. What is on your radar with regards to that? What would you watch to say, actually, something going on here that maybe we need to pay a little bit more attention to?
Well, from a financial stability perspective, traditionally the biggest sources of financial instability are leverage and maturity transformation and the intersection of those two. That's why banks are inherently risky. Levered 10 to 1 or more, they take overnight money and then they lend long into it. So for example, a lot of people have looked at private credit and said, this is a huge growing asset class, isn't this scary? As I've looked into it, they seem to be much less levered than banks, and they generally have longer term funding. So in those two primary dimensions of financial instability, leverage and maturity transformation, it doesn't seem to be riskier than banks, probably less risky than banks. So we continue to look for leverage. We continue to look for maturity transformation.
Neil, smart, as always, and good to see you.
Good to see you.
Thanks for your time. Thank you, sir. Neil Kashkari there, the Minneapolis Fed president. That does it for us from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special NITO ATP Finals update from Bloomberg TV and radio from Tennis Channel. Daniil Medvedev got his first win of the week as he dispatched Alex de Minaur in straight sets. The Russian looked like a completely different player to the one that lost his opener against Taylor Fritz. Medvedev fired 24 winners in the victory, which keeps his hopes of claiming his second crown at the season finale alive. And don't forget, you can watch all the action on Tennis Channel. Our daily coverage starts at 5:30 a.m. Eastern.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977, when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's You know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
There are many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone.
Estimates, and yet it seemed to move the markets. Here's a look at headline CPI over, the latest reading obviously here, and a 3-month annualized average. We're looking at continued gains here. So the Fed still has a lot to do, even if the bond market wants to hold on to the paper it has now.
But let's move away from the bond market. Let's talk about the stock market. That's what we do on this show. Focus on individual movers and shakers. Charter Communications, keeping an eye on that. Interesting to watch. John Malone's empire just consolidate. They've agreed finally to buy Liberty Broadband. You do see Charter Communications up 1.5% pre-market. Also taking a look at Mediterranean restaurant chain Cava, just soaring, up more than 16% this morning after increasing its annual projections. Shares, if you could believe it, are up over 230% just this year. And Spirit Airlines down hard as an agreement with creditors is expected to lead to the cancellation of the company's existing equity. Spirit now down almost 64%, Katie.
Yeah, down bad for Spirit Airlines. Excited to talk about that a little bit more later, but let's get to that CPI data coming in right in line with expectations. Minneapolis Fed President Neil Kashkari spoke to Bloomberg just moments ago. Let's talk about it.
Seems to be confirming the path that we're on. We've made a lot of progress in the last year or so bringing inflation down. Goods inflation is back down to where we want it to be, where it was pre-pandemic. Services inflation, which is tied to wages, is gently trending down. And then finally, housing inflation, we know, is a lagging indicator. We know that it takes a couple of years for the new leases to turn over, and the new leases are showing that we're headed in the right direction. So.
Leading that interview, of course, is Bloomberg's chief economics and policy correspondent, Mike McKee. He's now sitting to my left. Mike McKee, really interesting interview. There were really a bevy of headlines that we could go through. I thought it was interesting that he doesn't seem to think that inflation is stuck above the 2% target, but he also said that they need to take into account fiscal policy in their deliberations.
Well, that's the problem. We don't know what the fiscal policy is going to be. Donald Trump has a lot of slogans. He doesn't have a lot of thought through policies, at least that the markets or the Fed knows right now. So they've got to keep an eye on what's going on. Now, the interesting thing about the CPI numbers that came out this time, they were bang on expectations, but the month-over-month changes were on the low side when you go out to 3 digits, which is what the market is reacting to now. Just 0.24 for the headline and 0.28 for the core. There was a feeling that they might go higher than that and show more inflation pressure building, and that didn't happen, which is why maybe the markets are a little bit happier about what's going on. We got not a great report, but not a really terrible report. Then the next question becomes, as you mentioned, and we talked to Neil about, is inflation going to be stuck? And he doesn't think so, and he thinks these numbers kind of suggest that we're still on the right track. We're above the 2% target. We've gone up a little bit, but it's not going to be like last January when we saw a big increase.
Mike, even if inflation looks like it's headed in the right direction, my question is for who? Because if we still have sticky shelter costs and we have food prices higher, yes, we're past the election, but if you're looking at kitchen table issues, there's still a problem here.
Well, there's a problem, but there's not a great problem. It's more of psychology in the sense that the price level, we've talked about this many times, hasn't gone down. Food prices, food at home, grocery prices were up only 0.1%. They've basically been flat for the last 7 or 8 months. I'm sure that Kamala Harris is looking at the CPI numbers today and saying, why didn't I get this before the election? Because egg prices went down 6.7%. So the people who are complaining about egg prices, I mean, problem solved.
My mother.
Too late.
I found a dozen eggs, cage-free, for $3.99 at ShopRite.
I am now getting them from my cousin's neighbor's farm, so I get them for free.
Nice. Free is much better. All right, Mike, thanks so much. Mike McKee talking to us about not only the inflation numbers that we just got out, but also his interview with Neil Kashkari. Let's bring in Brent Schutte right now from Northwestern Mutual. He's the Chief Investment Officer at Northwestern Mutual's Wealth Management Division. Brent, what's your take on inflation? I really feel like we have two tracks going here, right? The actual numbers in the current economy and market expectations for sort of post-Trump policy inflation.
I think we're stuck here. I think we're a little bit too laissez-faire on inflation right now. If you look at the trend, the 3-month trend is moving back up. It feels a lot like last year. If you recall, the Fed kind of declared victory in the end of 2023, and then we actually had inflation rise back up in the beginning of 2024. And that's where I think you're starting to see some inflation rising already. Couple that with the fiscal policies that are out there, and I still think inflation is an issue the market is going to have to deal with in the coming months.
So taking the other side, of course, of what Neil Kashkari said, how do you invest around that? This idea that, okay, inflation is stuck, we're being too complacent here, but this looks like a Fed that is going to cut rates anyway. You take a look at expectations for December, for example, doesn't look like we're going to get that pause. So which reality do you invest around, that inflation is stuck or that this Fed is going to keep cutting?
I don't think the Fed's going to be able to keep cutting. I think the data is going to come in stronger on the inflation front, which is going to keep the Fed from cutting aggressively. Look, this is a later cycle economy. The unemployment rate is still low, even though it's risen. We don't have a ton of labor market slack. Wages, I heard Neil Kashkari say they're coming down gently. They've stalled out around 4%. Now, I know there's ECI and other measures, but they've stalled out about 4% on the average hourly earnings. There are signs that there are still inflation pressures that are out there. The stock market is at all-time highs, which creates a wealth effect. To me, the Fed isn't going to be able to keep cutting rates aggressively, and that's where I think the reality and the rubber meets the road, and that's why the bond market is up 80 basis points on the 10-year Treasury, even though the Fed has cut by 75 basis points. And so we're kind of in this area where it's going to be interesting to see what happens. I think at the end of the day, the Fed knows how to get rid of inflation. We'll just see if they actually are able to do that pushing forward.
Brent, I'm wondering how you are putting these views to work in the market, because we've talked about this before. You made this record-breaking wager earlier this summer when you thought about the long bond world. You made that view through TLT, through the largest long bond ETF. But how would you play it?
A $2.7 billion bet.
It was a record. It was massive.
Buying TLT.
And I know you've mentioned you've made this across many portfolios for your clients, so it wasn't just kind of like one lump sum payout for one person. But Brent, how do you now play this out?
So I still want to be in things that are cheaper. So I'm slightly underweight equities because there are historically high levels of valuation. I think we all forget about valuation at the end of economic cycles and think it doesn't matter until it does again. The CAPE ratio on the S&P 500 is at second highest levels all time. The earnings yield is now negative, as your own Gina Adams reported. And so to me, I want to be in things that are cheaper because I think about 3-year chunks, not 3-month chunks. And so to me, I want to be invested in small and mid-cap stocks. You've seen them go much higher over the past few months. I think we all forget that in mid-July, small caps outperformed large caps by 15% in a few days. Can anyone time that? I don't think the answer is yes. And then from the standpoint of the data, to me, the labor market is still weakening. We could be talking about something very different 2 weeks from now if we see a jobs report that is weaker, which if you look over the last year, take the denominator out of the unemployment rate and just focus on how many people have been added to household employment. The answer is a couple 100,000 versus 2.1 on non-farm payrolls. And so the economy is at this delicate balancing act where we could tip one way or the other. The big thing is I want to remain diversified. I want to have hedges on. That's where the 30-year Treasury is more of a hedge. And I want to be towards things that are cheaper.
I mean, is that position still open in those portfolios, Brent? Or did you lighten up in September? And, you know, going into an administration where we expect growth and possibly inflation to be spurred, do you want to keep it on?
I guess the question is, do you think all those things are going to happen with the bond market where it's at today, with the late cycle employment or late cycle economy where we're at? Is that a headwind if bond yields push higher that eventually leads to some sort of regression in bond yields?
But aren't bond yields telling us this? Isn't that a term premium and an inflation? Yeah, I mean, that's an indicator.
And so what happens if we have a labor market that falters in the next few weeks? What do you think happens to the 10-year Treasury and the 30-year Treasury? You think it goes much lower or much higher? And that's where, to me, it needs to be put in context of an overall portfolio. We are just north of the Barclays, the Bloomberg aggregate, duration target. We think there's opportunity there for investors to clip coupon. We want to be in higher quality bonds, not investment grade, not lower quality bonds where the spreads are very tight. You're not being compensated for taking a lot of risk, and that's where we've decided to put money towards that higher quality area across the curve, not just in the 30-year Treasury. That is part of an overall portfolio.
Well, it'll be fascinating to see if those hedging properties in the bond market actually come back, should we get that slowdown. Brent, unfortunately, we have to leave it there. Really appreciate your time. That is Brent Schutte of Northwestern Mutual Wealth Management. Meanwhile, a quick check on futures right now, a little bit of a rally, and you know that's being generous. If you take a look at the S&P 500 right now, basically flat, but the color is green. Can't say the same thing for the NASDAQ 100, slightly lower. Small caps coming back. The Russell 2000 had a wipeout yesterday, down almost 2%, but at least for this morning, higher by about 0.6%, Shanali.
And coming up next, Katie, we're going to talk about the president-elect's team that he's been choosing. We're going to give you the latest on the top picks for his new administration. Plus, Citigroup CEO Jane Fraser weighs in on where she thinks inflation is going in Trump's second term. Highlights of my exclusive interview later this hour.
Certainly there are elements of this that could be inflationary. At the same time, we've also seen, particularly here in the States, an ability to have productivity improvements and driving changes through. So I would say we've got to wait and see. People decide policy and determine policy. Let's see what the policies are, and then we can work out what's the response to it.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live every...
The future is here. As I said, we've got 50 Teslas driving autonomously. We're trying to give you a sense of what cities will be like in the future. And when you get in, you'll see like it's really quite a wild experience to just be in a car with no steering wheel, no pedals, no controls, and it feels great. And we have enough vehicles here, so everyone should be able to try it out and experience the set that we've built here. It's a very big set, so it's like really, we've used, I don't know, 20, 30 acres or something like that. It's really big. So it goes on, the ride's long. And we set it up to feel like a ride, like a park ride. So it'll be cool, and you'll get to experience it tonight. Something we're also doing is, and it's really high time we did this, is inductive charging. So the robotaxi has no plug. It just goes over the inductive charger and charges. So yeah, it's kind of how it should be. Thanks, guys. I love you too. So one of the things that is really interesting is how will this affect the cities that we live in? And when you drive around a city, or when the car drives you around a city, you'll see there's a lot of parking lots. There's parking lots everywhere, parking garages. So what would happen if you have an autonomous world is that you can now turn parking lots into parks. And so we're taking the ing lot out of parking lot. Welcome. So there's a lot of opportunity to create green space in the cities that we live in. So that would be quite fantastic. Oh, and also, what happens if you need a vehicle that is bigger than a Model Y? The Robovan. The Robovan is, we're going to make this, and it's going to look like that. Now, can you imagine going down the streets and you see this coming towards you? That'd be sick.
On itself, it's just a mammoth undertaking. And again, I think there's just kind of a lack of awareness.